Gunwani is with us. So let's get him in. He's Chief Investment Officer at Bandhan Asset Management Company. Manish, good to have you with us here. Thanks very much. I want to start with, of course, the big story, which is the largest ever IPO, Hyundai. $3 billion IPO. Soon, Swiggy is coming, I think, planning to raise just under $500 million. There's Vari, which will be there, and so many others. The demand in that demand for paper creating its own supply. I just wanted your thoughts on it. I mean, is it evenly matched, balanced, and what does it mean for secondary markets? Does it slow the pace down just a little bit?
Yeah, I would think so. So what we've been trying to do is tell investors, distributors that we need to keep our return expectations realistic. And just because structurally we are positive on liquidity, because broadly we think dollar will be weak and a lot of Indian money will move from fixed income to real estate and equities. But just because you're structurally positive on liquidity doesn't mean every 6 months, 12 months, equities will give a bumper return, because this liquidity will be met with a lot of supply. And supply comes with a lag, but I think we are seeing some very big IPOs in the pipeline. And I think we should, after making very, very decent returns over last 1, 2, 3 years, we should expect that next 6, 12 months should be pretty mediocre. I mean, we should be ready for that. No one can predict, but we should be ready for that.
Okay, so yes, indeed, Hyundai is going to be making all the headlines as that IPO rolls on. Manish, great to have you on the show. Thanks for joining in. But, in a more broader sense, what is your stance on auto as well as auto components right now? Because we're dealing with different cues. Global-facing companies on the ancillary side, they're looking at slowing demand. We all know what's happening in Europe. All these major OEMs are constantly cutting down rolling back their guidance. But then you have the two-wheeler guys doing really well here in India. PV somewhere in between. So, give us a big picture on auto.
So I do think it's very difficult to find great value there because, again, stocks have run up, whereas on the ground, we're not seeing supernormal demand. In fact, I think in four-wheelers, the demand seems pretty tepid at this point of time. So in that sense, I think the probability of getting a big surprise in earnings does seem minimal at this point of time. And given the P multiples, given the market cap, so if you see the market caps of two-wheelers, as you pointed out, versus the long-term growth that is possible. Obviously, we may get a cycle because rural consumption has a chance of picking up. But when you see that this is an industry which is fairly penetrated, so if you're buying something for domestic auto scene, then you need to get something which can get massive market share, which is not easy to pick. So I do think that when you see the overall market cap of either two-wheelers or four-wheelers versus what is happening on the ground versus what are the global market caps of companies in these spaces, I do think that's very, very difficult to get great value.
Hi, Manish. Good morning and good to see you. With Nigel on this side. Manish, suddenly China's coming back into play. And if China recovers, then it could be good news for the metal space. And we're seeing that these metal stocks are seeing a pop, at least as of now. What's your view? Would you build onto some of these positions? Or would you say that, let's wait for more, evidence that China is actually recovering and then get in? The other tailwind is that the Fed is cutting rates, which otherwise is positive. So how are you positioned on this space?
I would have a mildly positive view on metals, more tactical, because China's recovery, unless it is directed very strongly by policy measures, which some of it has happened, but we've not seen the bazooka come out in one sense. And I do think that they need a big bazooka because the real estate sector is very big. It's under huge pressure. And also, when you see the structural issues like demographics, etc., clearly it is not a very strong country in that respect. So to expect a sustained recovery in China at this point is too nascent. But yes, I think when you see rest of the market versus metals, when you see the asset value, when you see the free cash flow, the dividend yields, at this point, also helped by the fact that, as I said, if your medium-term view is that dollar will be weak. So the downside on commodity prices may not be too much from here, apart, of course, in the scenario where US goes into a deep recession. But right now, I don't think the market is pricing that in. So when you see on a relative basis, I think there is decent risk reward in metals and oil today.
No, absolutely. Got that. Just a quick word, if you will, on the sort of big, the large segment of the market, which is financials, Manish. The banks basically is what I'm referring to, because a lot of the capital market plays have all done very well, but banks have really not. So I just wanted your thoughts. Some believe, the underperformance is more than anything else technical, because it's about 25% of the market. It's a very large segment, takes a lot to move this space. Is that it, or are there any underlying issues?
No, I do think there are some challenges there, particularly on the CASA side, which we've talked before, that there are both cyclical and structural elements which are pressurizing CASA. So unless the banks display some pricing power, because if you see what is happening is that on a 1 year or 2 year basis, the balance sheet has grown more in the riskier parts, which is unsecured lending, SME lending, agri, versus the safer parts, which is AAA corporate or mortgages to salaried people. But in spite of that risk profile on the asset side moving up, we've not seen NIMs expand. In fact, we've generally seen NIM under pressure, which basically means on the same product, the margins are probably coming down, which is a lot to do with the liability cost. That if you see CASA as a proportion of the liability side, that has materially gone down over the last couple of years. Now, unless you see some kind of pricing pressure where this fall in CASA proportion is reversed by, let's say, cutting rates on savings account or something like that, very difficult to be structurally bullish. Again, the valuations are such that maybe the downside is obviously not much, but can we see massive earnings surprise? Looks doubtful.
Okay, all right, Manish, we'll leave it there. A quick conversation today. Appreciate your time, but it's good to get that. Thank you very much. Now,